Hi, I'm Pattu from FreeFinCal. Today, let's talk about a relative recovery in the performance of the active large cap category and a promising recovery in the equal weight indices. About a year ago, almost exactly a year ago, I had pointed out that the return difference between the Nifty 50 and the Nifty 50 equal weight indices were at an all time high. That is, in the published history, the Nifty 50 had never given such a higher return as above the Nifty 50 equal weight index as it did in December 2019. And I had talked about why this was the case, because only a few stocks, that is the top 5 6 stocks of the Nifty, were holding the market up, while the Nifty Next 50 was falling down, the mid cap was falling down, the small cap was falling down, and so on. I am talking about before the March 2020 market crash. Up to that, that was the kind of situation. Then the market crash basically removed this market imbalance momentarily, and then the market imbalance shot up again, and today it has gone away to a significant extent, as we will see. Immediately after the market crash in May 2020, I had talked about how 80% of the active large cap funds had outperformed Nifty and Nifty 100 in the last 1 year, trailing when you looked at it with respect to May 2020. So we're going to look at what is the situation now. I believe things are a little more on firmer ground today, and this is a comparison of the trailing returns of Nifty 50 in the first column, Nifty 50 equal weight in the second column, Nifty 100 and Nifty 100 equal weight. For those of you who do not know, if you look at a market cap weighted index like the Nifty 50 or the Nifty 100, the bulk of the weight will be coming from the top 5 or 6 stocks. The top 5 or 6 stocks of the Nifty will account for 50 to 60% of the weight, whereas the Nifty 50 equal weight will have about 2% weight for every stock, and about 1% weight for every stock in the Nifty 100 equal weight. So you can't have one stock alone dominating the proceedings, or the concentration risk would be significantly lower. So at the time when this article was published, which is like yesterday, I think so, with respect to that date, December 17th, maybe, if you notice, the last 2, 3, 4, 5 year returns, the Nifty 50 equal weight and the Nifty 100 equal weight has been lower than that of the corresponding base index, that is the Nifty 50 or the Nifty 100. Only in the last 1 year trailing, the Nifty 50 equal weight has outperformed the base index, and that is the change in the market balance that I'm referring to in this post. So if you look at this, so this is the 1 year rolling return difference between Nifty 50 equal weight and Nifty 50. That is what I am doing is I'm calculating the 1 year rolling returns of Nifty 50 equal weight, and I'm calculating the 1 year rolling returns of Nifty 50. And for the corresponding duration, I'm calculating 1 year return of Nifty 50 equal weight minus a 1 year return of Nifty 50. So that's the yellow line, and the orange line is basically the Nifty 50 total returns index. You can see here that the around August 2018, the 1 year return was very low, and then it started increasing, and then it fell down again, and then it started increasing, and today it is now gone above the zero marks, which means that the 1 year return of Nifty 50 equal weight is greater than that of the Nifty 50, which means that all the stocks are contributing to this rally and not just the top few stocks of the Nifty 50. That's what it means. The similar situation is with respect to the top 100 index as well. And with respect to the active large cap fund performance, but before that, just a little bit of trivia. In March 2020, the Nifty 50 had a 10.5% greater return, 1 year return, than the Nifty 50. That has now changed completely, and today the Nifty 50 equal weight is 5.5% more. So from minus 10.5% return, that is the Nifty 50 had 10.5% lower return, and now today it has gone up to plus 5.5%. That's a huge swing in the last few months. And if you look at the active large cap fund performance over the last 5 years, only 5 out of 27 funds have bet the Nifty. Or last 4 years, 5 out of 27. Last 3 years, 2 out of 28. That's when the market imbalance was the highest. Last 2 years, 11 out of 28, and last 1 year it's 11 out of 29. So you can see that whenever there is that huge market imbalance, all kinds of mutual funds, not only large cap but other kind of multi cap, large and mid cap, all of them struggled with respect to the Nifty 50. But that situation has, at least for the moment, changed, and I believe active funds should do better going forward. However, this does not mean that you should switch back to active funds and basically ditch index funds. I have always been saying that investors are looking at returns and switching to index funds. That is not a good idea. You should switch to index funds only because you will not be always invested in an active fund that will outperform the index consistently. There will always be ups and downs in the journey. That is the only reason you should switch to index funds, because it's a very simpler journey and it's easy for you to manage the portfolio. But this is a reporting video where I'm saying the market imbalance has gone down, at least for the moment, and the performance of active large cap should relatively do better. However, please note, even today, less than 50% of the large caps have only outperformed the Nifty 50. So it's basically choosing the best active large cap fund which will get you better returns is simply not possible. And if you appreciate this, then you can switch to index funds. Otherwise, I don't know how any kind of mutual fund investing would be better for you, because people are always asking for best funds. There is no best funds. You just can't have that. Either you pay extra fees and go through the periods of underperformance like an idiot investor that I am, or you be smart and switch to index funds. But be careful. There will always be news like this where people like me will say, confusers like me will say the active fund performance has gone up. Now the point is, why am I doing this video? I don't want to be a guy who spews hate towards the active fund industry and always says index fund is the best. That is as bad as saying active fund is the best. I want to present data to you. There will always be confusing data. You must be in a position to wade through that confusion and have a clear plan. So I have to have a neutral stance on this, and I don't want to be a guy who generates a propaganda about index funds. And as many of you know, I myself don't have index funds in my portfolio, but I do know that for people who are starting out, it's a very simple option. That cannot be two things about it. I prefer, for my age, for my asset allocation levels, I prefer not direct diversified index funds. I prefer a hybrid fund. I have a core hybrid fund portfolio. Of course, I do have PPFAS, which by luck or whatever has been doing so well so far. We will see, things will turn for everything. Every fund will go through these cycles. So you have to have a clear strategy. I don't have any problems with my strategy. I am not worried. Most people are worried when they see active index funds performing well. They started worrying and they went to index funds. Don't do that kind of thing. Don't switch or add index funds because of some fear of missing out. Do it because you have a clear strategy. That's all I have to say.